time to get an important voice in, just celebrating the Rise with India theme. And who better than Adrian Mowat, Chief EM and Asian Equity Strategist at JPMorgan, who's been watching India for the last 2 decades, joins us with his perspective on how he sees the India story going forward from here. Adrian, great to have you on the show. Thanks very much for taking out the time. You know, the world is talking about stretched valuations and how the markets could be ripe for a correction. And, you know, there's much debate about what would lead to that correction. Which camp are you in? How are you looking at the value versus growth story, specifically in India, but also if you could tie that in with the rest of the Asia view?
Yeah, so undoubtedly valuations are high versus the historic norms in India. We think there's a couple of factors at work there. One is, one could argue that earnings are a little bit depressed and we had a relatively poor results season. The other is the dynamics of what's happening to the local savings pool. So fixed deposit rates, particularly if you're rolling these things, have come down quite dramatically. Availability of real estate to invest in is temporarily subdued because of the Real Estate Reform Act. And I think the result of that is more capital is going into the equity market. I also think that there's a reasonable expectation about 2018 being a year in which you don't have the distortions of demonetization or GST, and it could be one that just feels cyclically better. And that's why the street's forecasting about 20% earnings growth for next year. So investors recognize valuations are high, don't think they can go much higher from here, but think it is reasonable to be optimistic on earnings for next year. The risk around that obviously is that if there is no pickup in activity next year driving that 20% earnings growth, then the market will look vulnerable. And I think it's probably 2018 that you should be getting more nervous. It's also important to think about the global backdrop here. You know, we have very low volatility in G3 economic growth. US growth is slightly above trend. The core PCE deflator is below the central bank's inflation target. So there's very little pressure on the Fed to do anything. So this is a very benign environment for equity markets. The final thing to point out here is that emerging markets had declining earnings up until 2016. They started to recover in 16. In 17, the recovery has been even stronger, with perhaps except India in terms of positive earnings revisions. The result is strong inflows into emerging market equities. Despite those strong inflows, investors are still underweight.
So just to take that point forward, Adrian, you know, everyone and their uncles are waiting for that much-awaited correction, which is completely, you know, eluding Indian equity investors, at least, and here in India, barring those few odd gyrations that we're seeing when you hear about, you know, North Korea testing a nuke missile here or there, and that's only 100 odd points on a given day. But what, according to you, could cause that correction? And would you believe that it has to be a global factor, or do you think India as a market could fall under its own weight as well? Or do you not see a case for a correction coming into India anytime soon?
Yes, it's often, you know, people say, can you forecast some black swans? And it's very difficult to forecast black swans by definition, but you know, is there something specific that we see in India near term? No, we don't see an obvious source for a correction. If there was an event that was a negative surprise, then India would be vulnerable at its valuation levels. I think on a global basis, we have to acknowledge the fact that macroeconomic forecasting failed to predict that US core inflation would stay so low. There's obvious a risk that failure to predict on the downside gets repeated on the upside. And so I think markets would be vulnerable if US inflation, so this is the core PCE deflator, which is the one that the Fed looks at, if that was to suddenly pick up, then I think you might see these very bearish positions in the dollar being covered, and you could also see a rise in US bond yields. So that's a potential catalyst. At the moment, the data isn't consistent with that, but that would be a sort of variable that I'd be looking at.
And what would that variable do for, you know, your own view on US interest rates? Because a large part of the whole liquidity story was driven with what happens to rates in the US. and how that impacts emerging markets, India included?
Yeah, so, as I said, I think the view now from the street is that the Fed maybe moves once in the next 12 months. So that's quite a change. The dollar is weak, positioning in the dollar is bearish. Our house view is still one more move this year, but obviously that's open for interpretation of the data. We think the Fed will go ahead with balance sheet adjustments regardless of the economic data, but we don't think that that's a particular threat to markets, as it will be very considered in its nature. So at the moment, I don't think interest rates are a big issue for emerging markets.
What about that, balance sheet recoil? Do you think that that could be something that the markets are not focusing on as much right now? I mean, I remember at the same time in the summer of 2013 when taper tantrums hit the markets world over, and sentiment was damaged for a little while. Do you not think that the markets are a bit overconfident about what the revision in the balance sheet would mean for liquidity and thereby market sentiment?
Yes, so let's examine that analogy. So May 22nd, 2013 was when the Fed published minutes with this new word, tapering, in it. Prior to that, the major events had been the BOJ, Governor Kuroda, talking about their QQE. So in 2013, markets are preparing for ECB and BOJ to expand balance sheets. The Fed had already been in a period of QE. The dollar had been weak during that time period where the Fed had QE, but the BOJ and the ECB didn't. On the announcement of tapering, the world woken up to an environment where you have a divergence in central bank policy, with the Fed coming out of QE while the BOJ and the ECB started QE. That resulted in the largest move in the dollar that we've ever seen prior to the first Fed move. This was a difficult environment for emerging markets. Remember, during the early periods of QE, you had very large inflows into EM fixed income markets, both hard currency and local currency. When you got that sharp increase in bond volatility, it resulted in capital outflows and a tightening of liquidity positions. So let's roll forward to what's going to go on in 2018. We do expect the ECB to start to taper their balance sheet. We think the Fed will no longer be reinvesting maturing bonds and coupons. But if you think about the direction, everyone's moving in the same direction. If we look at the macroeconomic data, arguably it's surprising more on the upside in Europe than it is in the US. So we don't think that this is an environment that causes a big dollar rally. We don't think it's an environment that causes a big vol shock in the bond market. So we would concur with investors not being too focused on it.
Let's talk about the more near term right now, Adrian. And if the current geopolitical tensions emerging out of North Korea were to escalate, what's the kind of damage or quantum of fall that we could see across the globe? Because, this is a known devil. Somewhere the markets are already beginning to price in something or some sort of escalation already.
I think that's a very difficult question to answer. The history of this is a North Korean regime that escalates its provocative moves, but they don't go any further than that. The aim of this regime is to stay in power, and I think provoking military action they would fail at that particular goal if they did provoke military action. All the indications that we have from the military experts, and including the current chief of staff, is that any military action would be a terrible humanitarian event, and it's almost distasteful to talk about this. Also would be a major hit to the global economy. I think what investors are doing is they're assuming that the status quo will continue and this will not escalate to military action. That has been the correct view in the past. I think it remains the correct view. What you need to do, though, is be aware that there are tensions between Korea, South Korea, and China. Those are hitting certain businesses, and as a portfolio investor, you should be conscious about that. That's why we're underweight the consumer stocks in Korea.
No, and we're keeping our fingers crossed on that front. War is not the scenario that we want to deal with at this point in time. Talking about what's happened in the Indian market, Adrian, over the last few weeks, has put the spotlight really on some of the marquee names, the poster boy companies in India. How have investors and your clients taken to the news of Infosys and the boardroom battle that ensued there? And what's their outlook on some of these big companies managing their management issues, whether it was the Tata Group earlier or Infosys now? And does it, cast a cloud on how they would approach investments among large companies in India?
Yeah, so, my perspective here is the global emerging market strategist. And what I'm finding with India is that clients have a very set position. If they are invested, if they are overweight, they're willing to sit there in these high valuations with the same stocks. And so my conversations tend to be much more focused on tech elsewhere, so tech hardware, the internet names in China, what's going on with Chinese banks, improving credit quality, rather than the details of what's happening with certain blue chip Indian companies. So it's a very intriguing dynamic that the global investor has sort of made up their mind and is sort of positioned there, rather than getting into deep, detailed discussions about this at the asset allocator level. I'm sure the Indian PM, will be much more active in this.
So aside of the sectors that you've already talked about, Adrian, tell me, what are your biggest underweight and overweight positions when it comes to Indian stocks?
Yeah, so we're running a position where we're neutral India within a bullish view in emerging markets. So remember, all our recommendations are whether you will perform in line, outperform or underperform the global emerging market index. Within that, we are overweight financials. We're neutral consumer discretionary. We like materials. We're underweight consumer staples. We're underweight pharmaceuticals. And we're underweight healthcare at this point in time.
Adrian, let me also talk about the commodities play, the metals rally. We had the S&P Metals Index go 9% higher in August, and the Chinese manufacturing data looked pretty decent as well, supporting iron ore prices. Do you think that the cyclical upturn that we are seeing in metal companies, which is rubbing off on Indian companies like Tata Steel, Hindalco, Vedanta, is in for perhaps another couple of years of an up move? Because for a viewer looking at these stocks, you have already seen gains running into double digits, 50% plus over the last 6 to 8 months.
Yeah, so, in thinking about the price of something, it's a supply-demand balance. And the interesting thing is it's supply-side reform, particularly out of China, that's driving very healthy steel margins. There's also supply-side reform for iron ore, and that's enhanced by the fact that the major iron ore producers are also careful about their production. So I don't really view this as some big cyclical kicker. I think it's much more a maturing industry with an overlay of a Chinese government that's very, very concerned about the profitability of the old economy. They care about the profitability of the old economy because the amount of corporate debt that there is in China. Back in 2015, only 10% of Chinese steel mills made money. I think it's some 90% currently. That's an important reduction in risk within the banking system, and that is ultimately what's driving policy. So I think there's a great irony here that the US is very concerned about steel prices and putting in place steel tariffs. We are long materials in Taiwan and Korea because, in our view, China's actually generating a pricing umbrella with its supply-side reform. And so we do like steel companies in the region because of supply-side reform in China.
Right. Okay. So that's the metal side of the story. You said you were underweight Korean consumer companies. What's the theme with India? Because it's really, given the environment that we are operating in right now, certainty for growth that investors are buying into. Is that a high conviction overweight position, Indian consumers?
No, just to clarify, we're underweight consumer staples. We think people are paying excessive valuations for the growth rates. We're underweight consumer staples globally. There's more growth out there. You don't need to be paying up for what are essentially defensive earnings. The consumer discretionary stocks in India generally are quite expensive. There are a few select names that we like. And then some are exposed to developed markets and not necessarily, have the exposure that we want. So selectively, we like consumer discretionary rather than blindly buying the index.
Adrian, you at JPMorgan have always been bullish in financials when it comes to India. But the fact of the matter is that financials is now such a large, growing basket. There are NBFCs, there are housing finance companies, and now the insurance sector in India as well is opening up. What within, aside of private banks and the creme ones at that, do you like within financials when it comes to India?
Well, you tend to have the best performance out of the NBFCs, particularly the housing finance names. But, practically here, the market cap remains within the banks, and then within MSCI India financials, it's about 80% the private sector banks. So, there's a degree of sort of nuance around this, but when I'm talking to the global emerging market manager, there's only so much that they can put to work at NBFCs. Now, there's documents filed talking about further insurance IPOs. I think people will be interested in those. But at the moment, where you can put money to work is in the banks.
And I guess that's only the private sector banks, right?
I think I'm not that bearish on the PSU banks because I think we're at the right point in the credit cycle. And we do expect a cyclically better India next year. Interest rates have been coming down. So I would be broadly supportive of the financials.
In the US, during the big bull run in the 1990s, there was a big surge of interest in insurance companies. I mean, Berkshire Hathaway had its biggest move during that run. And is largely deriving its value from insurance. Do you think that to be a theme which could just re-rate the financial sector in India? A lot of companies have insurance arms. Either they are, unlocking value by demerging those arms and getting them listed, or pure play joint ventures are coming into the market. HDFC Life being a case in point.
Yeah, look, I'm going to be careful about answering this question just because, with capital market transactions, I can't directly talk about these stocks.
No, I was just asking about the insurance sector as a theme. I wouldn't expect you to stock specific.
So maybe the best way to look at this is to look at the Chinese insurance companies which have been listed for a period of time. There is significant interest by global investors in insurance in emerging markets. These are countries where financial penetration, so the penetration of insurance products, savings products, is generally quite low. The growth in the middle class is relatively rapid. And so we're finding the underlying growth rate is very high for these products. And therefore, clients are interested in buying into these growth stocks.
Adrian, I'm quite curious to know what's that congratulations card that you've got behind us. What's the congratulations for?
Oh gosh, I didn't realize I survived 15 years here at JPMorgan.
Oh, okay, then congratulations from all of us at ET Now. Again, and may that 15 go on to another 15 if you wish so.
Thank you.
Okay, great speaking with you. Thanks so much for taking the time out and speaking with us today.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.